Hello everyone, and welcome to this video on understanding investment patterns relative to smaller and medium capitalization businesses. Investing in stocks is an excellent way to grow your wealth, and investing in smaller and medium cap businesses can offer higher returns due to their growth potential. However, it is essential to understand the investment patterns and the risks involved before investing. Smaller and medium capitalization businesses, also known as small cap and mid cap, are companies with market capitalization values between $300 million and $2 billion. These businesses are generally younger and have more growth potential than large cap companies, which are well established and typically offer lower growth potential. Now, let's look at the investment patterns for these types of businesses. One thing to note is that small cap and mid cap stocks tend to be more volatile than large cap stocks due to their smaller size and higher growth potential. This means that the price of the stock can fluctuate significantly over a short period, making it riskier to invest in them. The investment patterns for small cap and mid cap businesses can vary depending on various factors, including market conditions, economic factors, and company-specific information. Here are some of the general investment patterns to keep in mind when considering investing in small cap and mid cap stocks. 1. Higher volatility. As mentioned earlier, small cap and mid cap stocks tend to be more volatile than large cap stocks. This is because small cap and mid cap companies are less established and have less predictable earnings, making their stock prices more susceptible to market fluctuations. 2. Greater growth potential. Small cap and mid cap stocks have higher growth potential than large cap stocks. These companies are typically younger and have more room to grow compared to large cap companies, which are often more mature and have limited growth potential. 3. Less research coverage. Small cap and mid cap companies tend to have less research coverage than large cap companies. This means that investors need to do their own research to identify potential investments and determine their potential for growth. 4. Active investment strategy. Investing in small cap and mid cap stocks requires a more active investment strategy than investing in large cap stocks. This is because small cap and mid cap companies are more sensitive to economic changes and market conditions, requiring investors to monitor their investments closely. 5. Potentially higher returns. Despite the higher volatility and risk, small cap and mid cap stocks can offer higher returns than large cap stocks over the long term. According to some studies, small cap and mid cap stocks have outperformed large cap stocks over the long term, providing higher returns on average. It is important to keep in mind that these investment patterns are generalizations, and each small cap and mid cap company is unique. Therefore, it is crucial to do your own research and analysis to determine which companies offer the best potential for growth and long-term returns. However, small cap and mid-cap stocks can also offer higher returns than large cap stocks. Small cap and mid-cap stocks can offer higher returns than large cap stocks, but they also come with higher risks. This is because small cap and mid-cap companies have higher growth potential and are more likely to experience rapid growth, which can result in higher returns for investors. However, smaller companies are also more vulnerable to market fluctuations, and their earnings can be more volatile than larger, more established companies. This means that investing in small cap and mid-cap stocks can also result in higher losses if the company does not perform well. It is important to note that the higher returns of small cap and mid-cap stocks are not guaranteed, and investors need to do their own research to determine the potential of the company and its ability to grow. It is also important to have a diversified portfolio that includes a mix of small cap, mid cap, and large cap stocks to minimize risk and maximize returns over the long term. Another thing to consider when investing in small cap and mid cap stocks is that these companies tend to be less researched and less well known than large cap companies. Large cap companies are typically well established and have a lot of analysts covering them. This means that there is a lot of information available on these companies, making it easier for investors to assess their potential and make informed investment decisions. On the other hand, small cap and mid cap companies are generally not as well known, and there may be limited information available on them. This lack of coverage and information can make it more challenging to assess the company's potential and determine its future prospects. However, this also presents an opportunity for investors who are willing to do their own research and take a more active approach to their investments. By doing thorough research on small cap and mid cap companies, investors can identify potential opportunities and make informed investment decisions. One strategy that investors can use to research small cap and mid cap companies is to look at their financial statements and assess their fundamentals. This includes looking at metrics like revenue growth, earnings per share, and cash flow to determine the company's financial health and future prospects. Investors can also look at the industry and market trends to determine the potential growth opportunities for the company. By analyzing the company's competitive position and market share, investors can get a better idea of its potential to grow and succeed in the long term. Investing in small-cap and mid-cap businesses requires a more active investment strategy, including thorough research and analysis. While these companies may be less well-known and less researched than large-cap companies, they can offer higher returns due to their growth potential. So, it's essential to do your own research and assess the company's potential before investing in small-cap and mid-cap stocks. Additionally, investing in small-cap and mid-cap businesses requires a more active investment strategy than investing in large-cap companies. Small-cap and mid-cap businesses are more likely to be affected by economic changes and market conditions. This means that investors need to be more active in monitoring their investments and adjusting their strategies accordingly. For example, small-cap and mid-cap businesses may be more vulnerable to economic downturns or changes in consumer behavior, which can have a significant impact on their stock prices. Investors need to be aware of these risks and be prepared to adjust their portfolio as necessary. In contrast, large-cap companies are typically more stable and less likely to be affected by short-term market fluctuations. This means that investors can take a more passive approach to investing in large-cap companies, focusing on long-term growth rather than short-term market movements. Overall, the level of activity required for investing in small-cap and mid-cap businesses will depend on the individual investor's investment goals, risk tolerance, and investment strategy. However, it's important to keep in mind that investing in small-cap and mid-cap stocks requires a more active approach than investing in large-cap stocks due to the higher volatility and greater potential for short-term market movements. To sum up, investing in small-cap and mid-cap stocks can offer higher returns due to their growth potential. However, investors need to understand the investment patterns and the risks involved, including the higher volatility and the need for more active investment strategies. It is essential to do your own research before investing in these types of businesses. Thank you for watching, and I hope you found this video helpful in understanding investment patterns relative to smaller and medium capitalization businesses. Please don't forget to like, share, and subscribe for more informative content.